going on, traders? It's Dada FX representing Clear Trading, and today we're going to be going over the Commitment of Traders report. So let's get right into it. Quick legal disclaimer regarding investment decisions and trading. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. Past performance is not indicative of future results. The high degree of leverage can work against you as well as for you. Before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or even all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risk associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. So, getting right into it. With the Commitment of Traders report, there's one thing you're going to be focusing on that's very important. That's open interest. And pretty much open interest represents the total number of future contracts held by market participants at the end of the trading day, and essentially is two components of a term called liquidity. Now, open interest reflects traders that have committed money to risk or have committed to the market. Open interest considers any open position that has yet been closed by an offsetting transaction, and is pretty much used as an indicator to determine market sentiment and the strength behind a price trend. Now, keep in mind, it actually takes two parties to create open interest, a buyer and a seller. It's different from open positions, which are orders that haven't been filled yet or executed. Now, volume is the record of these transactions, and open interest is essentially the result. So, one thing you need to keep in mind is, with open interest, when there's an increase in open interest, that's a strengthening trend, whether an uptrend or a downtrend. When there's a decrease in open interest, that's a potential weakening trend, whether it's an uptrend or a downtrend. Hope that makes sense. So, with the Commitment of Traders report, what is it? The COT is provided by the Commodity Futures Trading Commission, or the CFTC. They're pretty much like the governing body of all the U.S. futures. And this report accurately provides historical records of the U.S. futures markets. And this report breaks down open interest by position types and the market participants involved. Now, there are three position types: long, short, and spread. Long is buying, short is selling, and spreads is, spread over multiple months or multiple contracts. For example, if I was to buy a November contract and sell a June contract. Now, the participant types are as follows: commercial and non-commercial. And that's something we're about to get into. So, commercials versus non-commercials. Commercials are hedgers. This group includes companies or traders that deal with actual commodities as a part of doing business. So, they're pretty much hedgers that deal directly with our commodities and financial instruments. And their primary focus is trying to lock in prices for input cost or profit margins. Now, that being said, the primary focus is to utilize future contracts to lay off risk in order to ease economic activity. And commercials are exempt from position limits and post smaller margins than speculators. Now, what's up with our non-commercials? That's our speculators. And this group's main purpose is to take on risk in order to profit from the change in price action. Large speculators hold enough positions that it's actually required to be reported by the Commodity Futures Trading Commission, or the CFTC. Now, these non-commercials are subject to position limits. And that's significant for us because we want to look at the tendencies and probabilities when it comes to that. So, legacy versus desegregated. These are two reports that we're going to be focusing on. Now, first, with the legacy report, it's pretty much a nice report for us because it gives us a quick snapshot or overview of our markets. And we could look at our legacy report and identify a market that we may want to go into deeper or look at with a greater depth of information. It's pretty much a big picture report. Now, what the CFTC does is they break down this report and they create more detailed reports. And one of these reports is our desegregated report. Now, our desegregated report, it actually looks at our physical markets or our commodities, and it's broken down into subclasses or into 4 classifications. Now, these 4 classifications are as follows. First, we have our producer, merchant, processor, user. That's pretty much our commercial traders who are in the know of these markets. And they're basically our makers and takers. So they're the ones making or producing the products and using or processing the products. And they know when price is relatively low or high. So when prices are very high, they tend to be selling. And when prices are very low, they tend to be buying. And when these commercial traders are more active, they're using future markets to lock in low or high prices. Keep that in mind. It's very important. Now, our swap dealers. This could represent both commercial and non-commercial, but they fall under the same, they fall under the commercial category as far as the CFTC is concerned. Now, our money managed or our money managers, that's our speculators. They're trend traders, so they tend to ride the trends, and they really help with pushing our prices from a high to a low or vice versa. So in other words, they're pretty much involved in moving a trend along that the commercials may create per se. Then lastly, we have our other reportables. That's pretty much a catch-all category. Now, what we want to focus on is the role in which one of these classes have in determining our prices and our trends, and what is the probability or tendencies that occur when one of these classifications or pretty much one of these bigger buckets of traders are more active. So, some COT key points. The COT report is not a timing tool. It simply gives us insight on who is driving our prices. Something you want to know or keep in mind is you want to know who the players are and what is their role. Now, commercials, they tend to be more active at highs and lows in the market, and non-commercials tend to be more active with our trends. Regardless, if you see a significant large amount of positions from either class, this is usually an indication that our markets are vulnerable to a change in trend. And as we discussed in the beginning of the video, added positions could equal to a potential strengthening trend, and decreased positions could add to a potential weakening trend or be the catalyst of a weakening trend and, adding positions to a strengthening trend. So how can we use the COT report and apply it in our trading analysis? Well, one, we can identify the differences between large groups of traders, our hedgers and our speculators. Two, we can find historical high long positions and historical high short positions, which in turn would equal a potential change in trend. Three, we could find inflection points of increasing or decreasing open interest, which pretty much is a change from net short to net long and vice versa. And that could be a potential beginning of a new trend, a signal for a potential beginning of a new trend. Four, we could discover which group of traders are leading the market trends. Five, we could find correlation in rising open interest with strengthening trends and decreasing open interest and weakening trends. These are all things that we can basically apply in our trading analysis to give us an edge. So getting right into it, what I'm gonna do is I'm gonna show you where to find the COT report from the actual website of the CFTC. Then I'm gonna show you a website where you can find the same information, but it's much easier to look at. Then I'm gonna show you a website that you can tie all this together and kind of look at your historical high long positions and historical high short positions to see when there might be a potential change in trend and much more information. Okay, so let's get right into it. So first, this is the CFTC website. You go to cftc.gov, go to market data and economic analysis, click on commitment of traders. Now, when you get to this page, it gives you a lot of good information of what it is, the type of reports that they provide. Another report we're going to look at is traders and financial futures. That's also important. You could look at the release schedule. The COT data is released every Friday, and pretty much it includes data from the previous Tuesday. So here's the schedule. Now, when you want to go and find your legacy report, it'll say current legacy report, and you want to go to Chicago Mercantile Exchange, click on long format, and you'll have all the information you need right here. Now, what we're going to be focusing on is open interest. Open interest is what we just discussed, and you'll have your non-commercial and commercial, the two classes we just went over. So you can see that, you'll have your overall long and short positions and then a change in commitments from that week. Now, generally speaking, as we just spoke about, when you see an increase like this in long positions and then a close in shorts, you can assume that, the New Zealand dollar is getting stronger. Now, it's not as easy as it seems. You can't just look at this. And this is why I'm going to show you some more websites where you can log more than just 1 week of information. So you can kind of, refer to more information to see how price or how a market is doing over time. So pretty much we're going to be focusing on everything in this area right here. If you can see where my cursor is going, we're going to be focusing on long and short, not really worried about spreading. And we're going to be focused on long, short, then the changes in commitments, the percentage of interest represented by each category. So that's pretty much like the percentage that, that is long and short. That makes sense. And that's pretty much it. We're going to be focusing on this information right here. Now, there's a website I'm going to show you that takes all this information and puts it in a much more easy to look at format. It's much more pleasing to the eyes, to say the least. And that's tradingster.com. Tradingster.com, when you go to tradingster.com, it'll take you to this main page. You'll have your currencies, stock indexes, treasuries, energies, metals, softs, all that. Now, what we're going to do is, we'll click on, say, the Australian dollar. You'll see, as we just discussed, our long, our short, the changes in the both for the week, and then the percentage of interest for each category. So pretty much for the Australian dollar, the big group of non-commercial traders are 40% long and 36% short. And from the week that we're looking at of March 2nd, which was that Tuesday, they have added 5K long positions and closed 2K short positions. So essentially we could assume that the Australian dollar is getting stronger, right? So what you also can do is you can look at previous week's information. You can click on a week and it will take you to that right there. And this is important because essentially what you want to do is take all the currencies that you use or you trade, and you want to put it in a graph, or like go to googlesheets.com, not googlesheets.com, but use Google Sheets to create these spreadsheets and basically plug in your information, the date, long, short, change in long, change in short, percentage long, percentage short, and then the total net positions, which is basically, long minus short. And this information is good because, you might see something in 1 week where it's all these added shorts, but it doesn't necessarily mean that, the euro is necessarily just weakening, Obviously for this week, they've decreased net positions or open interest, so that could mean a weakening trend. But when you look over time, it may tell a different story. But just for this example, we clearly see that, the open interest has been decreasing over time, and euro is actually getting weaker, even though that overall they have a significant amount of longs opposed to shorts. So next, what I want to show you is a website called barchart.com. So when you go to barchart.com, they're going to ask you to sign in. You can sign in with your Google account. When you go to barchart.com, you click on futures and you go to legacy report. Now, when you get here, there's some really good information here. And what they do is they mark off significant highs and lows in the information provided by the CFTC. So when I go to currencies, for instance, I'll be able to see, okay, the British pound, they're at a 52-week low. And what did we just discuss? When we find a historical high long position or historical high short position, that's a potential change in trend. Now, what does that mean? well, this could possibly mean a potential change in trend. They're obviously, this is the commercial, and we know that they tend to buy at a very low price, or they tend to sell at a very high price. So we can assume that, with with the British pound, it might be, you know, a little bit ahead of itself. And that may be why the commercials are starting to short the British pound. Now, keep in mind, when it comes to the COT report, all the pairs provided are traded against the United States dollar. So if you're working with GBP USD, you're looking at exactly what you need to look at. So anyway, when we go here, we see that there are a significant amount of shorts, meaning that there might be a potential change in trend. Now, also, not to confuse you, if you go to non-commercial, you're going to see the exact opposite right here, right? So what does this tell you? Well, we know that when you see an increase in open interest, that could be a strengthening trend. They've been increasing their open interest. But also, because this is a 52-week high, it may start to shift to the opposite way. They may start closing positions. And, it might be old money going out the market, basically causing price to possibly go down even more. Who knows? This is how you want to gauge the information provided by the COT report. So, for example, what I want to do first is, with all these currency pairs, you can click on this little icon right here, and it shows a chart. So when we click on this chart, it's called a flip chart or a quick chart, and you can click on a year to show your daily chart. And what this does is it gives you an idea graphically how and where, which groups are moving the market. And you could clearly see, when they were at a significant 52-week high, this red line representing commercials, that could have signaled a potential change in trend, right? And if we look, they were pretty much, there was a correction and it was coming back up to this previous high. You can also say, price was probably basically moving sideways. So this could have signaled a potential change in trend when we seen this high right here. And that's kind of exactly what happened. They started decreasing positions, and positions from our non-commercials started decreasing. What does that mean? Decreasing position means a weakening trend. And pretty much with them both closing positions or old money leaving the market, that actually drove price to start going up. And then we could clearly see where our non-commercials started to push price from a low to a high, this green line, right? So we could kind of see literally what we just discussed, how it works and why it's important to look at both buckets of traders. You really don't want to just be looking at non-commercial information and just going buck wild with it. It's important to see what players are moving prices in our trends and what role do they play. So to go in more detail, I'll show you a trade that I actually took and how I utilized the information. So for instance, with GBP USD, we clearly see it's in a strong uptrend. It hasn't even broken the major trend line yet, so it's technically still in a very strong uptrend, right? Very strong uptrend. And if anything, this is just a nice correction for price to possibly start going higher. But something that we need to note is this. We see that this is a high, right? A high that's happened pretty much. It hasn't been this high since 2020. And just to be technical, since 2019. You know what I'm saying? Price was here literally April 2018. So it's been a while. It's been a couple years. And with that being said, we see something very important. And what is that? Well, I'm going to tell you right now. So as we just spoke, the commercials tend to be selling when price is at a high and vice versa. So we can kind of see why when we look at our commercial that the British pound had a significant amount of shorts, right? 48K shorts. So with that being said, there's something very important to look at. Okay, so what does this mean for us? Maybe we could start looking for short positions because that's a potential change in trend, which we clearly see. Now, just to be fair, what I want to show you is something very important. I took trades based off February 23rd. So February 23rd was when the report, that was where the data was taken from. And it was actually, I forget what date it was. We're going to actually look. So February 23rd was when that report that I referred to take my trades, that was when like the information was taken from, and it was reported on the 26th. So I didn't trade obviously Saturday or Sunday, but I traded on the 1st, which was Monday, March 1st. So we're going to go to March 1st. And what I'm going to do is I'm going to take it to 4 hour. And I'm going to use this playback tool and go to March 1st. All right. So this was March 1st. And what I want you to keep in mind as well is last week, this was red. This was the 52-week low. It's just that this week they've added more to their positions. So, it's telling an even, bigger story. But just to keep things simple, last week this was red. I looked at it like, okay, this is a potential change in trend. I already seen this big move to the downside, the double top, breaking the neckline right here. So what I was assuming is, okay, I took my Fibonacci, took it from the swing high to swing low. I seen price at the 38.2. Now that was actually February. So let's go to the 1st. That's 4 hours. So I'll take it down to the 1 hour. So that was February 1st at 4 o'clock, which falls right into exactly, I started at 3 o'clock. But pretty much when, I was in the London session, March 1st on Monday, I seen this double top. And typically with GU, when you see these double tops, and even with this, we never know price may meet this neckline. You'll see formations like this, where price will retrace and hit this neckline of the double top, and vice versa with double bottoms like that. So with that being said, I was waiting for a move back to the neckline, and I put in a sell limit. So my sell limit was literally like right here, and my stop loss was just above market structure, and my profit target was at the 0 of the Fibonacci. Simple 1 and 2. So price went along, hit my take profit. Okay. So with that being said, what I did next is, I anticipated another move. I kind of waited for price to get back to a level of maybe breaking this area and retracing. But honestly, I kind of seen price was moving in a consolidated area. So I was just waiting, and just to keep in mind, that week of the 23rd on March 1st, I noticed from a non-commercial, this information I have here that I log in all these spreadsheets is just non-commercial information. And I seen that there was 7K longs. So from a non-commercial point of view, I'm like, okay, well, they put a significant amount of longs in. So what's going on? But you got to keep in mind, this is information from the 23rd. So this obviously could have been this right here. And this could have been that big move that came from this right here, right? But still, we use this as market sentiment. So it doesn't mean just because this happened that it's over. There is a significant amount of positions, and the market needs liquidity to fill these orders. So market makers are going to move price in whatever way they want to kind of make things work for them. So anyway, as price was going along, I noticed that it started coming back to the top of the 38. So I put in another sell limit. I believe it was somewhere around here. And, I put, my stop loss above the 50. And I just took it basically to the same area of the 0. See how it plays out. Yeah, so it filled my order. And I know price eventually hit my take profit. Yeah, hit my take profit. And I had I had almost 200 pips just in a couple days. And I actually passed my Audacity, my first wave, I guess, or my first profit target just off these 2 trades. So it was definitely helpful. And I utilized the COT data. Now, something else that I want to share with you, just as a side note, is that you can use the IG client sentiment report. This is what you could type in on your address bar to get there. It's provided by dailyfx.com. And pretty much they provide a contrarian bias of the markets. And what this tells you is, usually retail traders are on the opposite or the wrong side of the trades that are profitable. So pretty much they take a contrarian bias or the opposite bias of whether you should buy or sell. I don't suggest ever using this just to take trades, but you can use it as a confirmation. So obviously this is updated as of March 8th, 2021, but it said the same thing when I took these trades. And it said traders are further net long than yesterday and last week, and the combination of current sentiment and recent changes gives us a stronger GBP USD bearish contrarian trading bias, meaning that pretty much retail traders are more net long than net short, and they usually tend to be on the wrong side of the trade. So with that being said, it's just more confirmation that price could continue to the downside. Now, that's pretty much all I have with the COT data. Just some key things I want you to keep in mind are that the COT report is not a timing tool, simply gives us insight on who is driving our prices. And what you want to know is the players and their role when it comes to the COT data and how they're moving the markets. Commercials tend to be more active at highs and lows in the market, and non-commercials tend to be more active with our trends. And when you see a significant large position from either class, this usually is an indication that our markets are vulnerable to a change in trend. When you see added positions, that's a potential strengthening trend factor. And when you see decreased positions, that's a potential weakening trend factor. And pretty much this factor right here, it really is in like confluence with the fact that this right here, which I want to show you. When you see historical high long positions or historical high short positions, that's a potential change in trend. And then when pretty much you see a significant large position from either class, that's usually an indication that our markets are vulnerable to a change in direction. Pretty much the same thing. And with that being said, when you see this, you see that significant amount of sells, that's because there might be a potential change in direction as far as the markets, which has happened, right? And also, when you look at non-commercials and you see a significant amount of, positions in one direction, you also want to keep in mind this is a high. And what happens from a high, it starts to go low. So they could start closing positions next week, or it could increase. But this can give you a confluence of, okay, well, then they're going to start decreasing their positions. And if they have long positions, that essentially means they're going to be selling, pushing price further down, right? So that's just something you want to keep in mind. And just not to confuse you, I really focus on non-commercial when it comes to market sentiment, but I do pay attention to commercials when there's a significant high or low or it changes from negative to positive. As I said, commercials tend to, be more active at highs and lows in the market, and non-commercials tend to be driving the trend from a high to a low or vice versa. So that's pretty much everything I wanted to go over in regards to the COT data. I hope it was short, brief, and didn't take up too much of your time. And if you really enjoyed the video, like, subscribe, and comment. Let me know, I'm doing well. And I'll definitely be provide more information to you guys, and let me know what you want me to do a video on. And I'll see you next time. All right, so stay profitable.